Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. First off, a couple of very big thank yous. Last week, Maria Bartiromo, Mornings with Maria, Fox Business Network. Maria, thank you so much for having us again and allowing us to engage in this Fed dialogue. Jim Caron, Morgan Stanley, thank you so much for joining us for our Fed preview. We take it very seriously. It's been a big part of our firm over the last couple of years. Obviously, the market is watching. So thank you very much. Wild ride in treasuries overnight. Volatility clearly back as the market tries to disseminate last week's Fed meeting. And we break it down. We listened and looked at the language, Powell's presser in the end. For us, in general, not a great surprise in terms of what he came out with. He finally acknowledged that inflation could potentially run above what the Fed expects it to be at. When you look at the SEP, you look at the dot plot, you look at inflation, 3% core PCE. We will get a reading again this week. No surprise at that bump, but then taking it down very close to target for 2022 and 2023. Bullard on Friday, he was pretty clear, right? He's in the rate hike camp of 2022 because he feels inflation is going to be higher than what the Fed is actually penciled in terms of their SEP. So what does it all mean, right? There are two things going on here, and it's important for the market. The Fed is trying to communicate it. There's tapering and there are rate increases liftoff off the zero lower bound. Right now, the Fed is focused on tapering. Powell has been clear about that. The Fed has been clear about that. They want to separate those two things. It's not necessarily going to be that easy or clinical, but here's how the timeline lays out, right? Powell made his pivot at this past meeting. The Fed is going to continue to engage in this dialogue on tapering in July. We've got Jackson Hole in August. We've got a meeting in September, and then tapering will take place. It could take place toward the end of 2021 this year. It could start at the beginning of 2022. But the Fed is going to be very deliberate. They're going to be very boring. I think this past meeting was telling the market, look, we're alive. We see what's going on, and we're going to start to engage in this dialogue, which I think is very, very healthy. After that, and tapering that timeline, this balance sheet is going to continue to grow. We see the liability side. We see the TGA, bank reserves, reverse repo. We see how that's all moving. So to the extent that balance sheet expansion here is going to be accommodative is very questionable. I think the Fed knows that at this point. But that timeline is going to take some time. It could very well take into the end of 2022, which does lend itself potentially for rate increases in 2023. So I don't think there's anything terribly inappropriate about what the Fed put down on paper. The market is obviously reacting positions. That's been the theme for 2021. But if you really get in the weeds with the Fed, you listen to recent speeches by Vice Chair Clarida when he talks about what is some time. So the bar for rate increases and the bar for substantial are different. Some time is a year or two of the Fed running above its 2% inflation target. So certainly this year, next year, into 2023, that timeline seems totally appropriate. We will get a ton of Fed speak in the week ahead here. We will get another reading on PCE, and we should start to get, I think, a little bit of clarity in terms of the labor side of the equation, which we have been harping on really as the main criteria for the Fed to move here. But for all intents and purposes, I think what the Fed is saying is we see the bottlenecks, we see the jolts, we see people not coming back to work. Here's why we think they're not coming back to work, but we expect those bottlenecks to work out in the course of the summer into the fall. The Fed needs to stay ahead of the curve here. This is a very strong dynamic, a very strong moving economy. Wishing everyone a great week. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities.